Today we're going to look at learning how to identify different account types. In accounting, there are 5 basic account types. These are assets, liabilities, revenue, expenses, and owners or shareholder equity. So what do these account types mean? Well, you need to be able to understand what each account type means. Why? Because it provides the foundation for transaction analysis and all accounting. So these are really important concepts for you to understand. What we're going to do today is go through what each account type means one by one. The first we're going to look at is assets. Assets are items of value that the business holds for further use. They can either be physical assets, i.e. you can go out and touch and feel them, such as a motor vehicle, or non-physical assets, like for example goodwill within your business. Put simply, assets can be used again to either increase profit or to reduce liabilities. One example of assets that can be used to increase profit is inventory, because inventory can be sold for a profit. So an example of inventory is if you're an office supply business, you might have an inventory with paper, with staplers, with pens. All of these can be sold within your business for a profit. Most assets are held because they can give you some further benefit down the line, i.e. profit. The other thing is they can also be used to reduce liabilities or things you owe to someone else. An example of this is your business bank account. You can use the money in your bank account to pay your bank loan each month. Plus, your business bank account also has a dual purpose, as it can be used to reduce liabilities, like a loan, but it can also generate its own income in interest. When doing account identification to work out if an account is an asset or not, you need to ask yourself, is there some future benefit for my business? Or can I use this account to reduce an obligation, such as paying an account? If the answer is yes, you most likely have an asset. Remember, the benefit does not have to be immediate. Land may be held for 20 years before it is used, but it still has a future benefit. The next account type we're going to look at is liabilities. Liabilities are amounts owed to finance your assets. For example, to purchase some new supplies, you purchase them on credit. This creates an accounts payable liability, and in return you get a supplies or inventory asset. When doing account identification with liabilities, you need to ask yourself, is there some future obligation for my business, or will this account be used to reduce a benefit, such as paying your bank? In this instance, the repayment of your bank loan, your liability, reduces your bank account, your asset. Remember, the obligation does not have to be immediate either. Many loans are held long term and may not require immediate payments to be made. Liabilities include such accounts as bank loans, accrual accounts or other items payable, trade creditors or accounts payable, bank overdrafts and credit cards, and any other accounts where you owe money to a third party. Owner's equity or shareholder's equity, as it is sometimes known, is the difference between assets and liabilities. It represents the net amount of what has been invested in the business by its owners, and it also represents what the business has earned during its years of operation. It is different to assets and liabilities in that it is separate from the day-to-day operations of the business. Owner's equity accounts can be identified by asking yourself, is this account related to the ownership of the business? What accounts are connected to ownership? Drawings. Anytime something is withdrawn from the business for the owner's personal use. Capital, which is an investment in the business. Dividends. as a return to shareholders, and retained earnings. And these are earnings that the business has generated which can be returned to the owners. So far we have covered the three basic balance sheet account types: assets, liabilities, and owner's equity. There are still two important account types to cover: revenue and expenses. Revenue accounts represent any sort of income accounts. These can include sales revenue, service fees, rental income, and any other income accounts. Identifying revenue accounts is relatively easy. If you can identify that an account produces income, you have a revenue account. Complications can arise when you try to determine if and when the income has occurred. One example of this is unearned rent revenue. In this scenario, we have received money for rent, but the period for the rent has not occurred yet. An example of this is if I receive $500 this month, but it is for the rent for next month. So, in this case, this creates a new account called unearned rent revenue, which is a liability account. So the difference between a revenue occurring and a liability account occurring is the timing. So in identifying if you have a revenue account, you need to ask yourself, has the transaction occurred yet, and is it an income? If it hasn't, you can dismiss the likelihood that you have a revenue account. It is then very likely that you will have a liability account instead in the form of unearned revenue. Expenses too are fairly easy to identify. If you have a telephone bill, this will create a telephone expense. Like revenue accounts, the difficult part is determining the timing of the transaction. However, instead of creating a liability account in the form of unearned revenue, expense transactions could also be prepayments if paid in advance, such as rent paid in advance. Prepayments are asset accounts because there is a future benefit to you. If you pay next month's rent today, you don't have to pay it next month, which gives rise to a future benefit. They can be accrual accounts as well if the invoice or transaction hasn't occurred yet. This is the case if you estimate your annual accounting fees are going to be $12,000 at the end of June, so you record $1,000 each month to account for this expense. So this concludes the 5 common account types. However, there are also 2 other types of accounts: contra revenues and contra assets. So, when dealing with contra accounts, they have a direct relationship with their associated account. One really good example of this is fixed assets and accumulated depreciation. Accumulated depreciation on its own does not qualify as any of the other 5 types of accounts. It is a negative asset and reduces the value of the fixed asset over time. This is what contra accounts do. They reduce the value of their associated account. Contra accounts are not limited to contra asset accounts either. There is also a contra revenue account, sales returns. It is not an expense, neither is it a revenue. Rather, it reduces the value of sales revenue. Remember, there are 7 different account types in all: revenue, expense, and contra revenues for profit and loss items, and asset, liability, equity, and contra assets for the balance sheet. The key to learning your account types is to practice identifying them. Success comes with much practice, so get in as much practice as you can, and then it will become second nature to you. I'll leave you with this quote from Henry Ward Beecher: "To become an able and successful man in any profession, 3 things are necessary: nature, study, and practice." Thanks for listening.